Okay, welcome everyone. We'll start our second lesson. Today lesson will go through our LO2, which is learning outcome to be able to use cost accounting technique and pricing strategy. My name is Anjum Satar and my email address here, and you can drop me and copy into learner work as well, please. If you have any questions, we have a compare, explain, analyze, and assess. So that's what we'll go through. Let's please, in lesson one, you also learn about contribution and pricing strategy. Further, we'll enhance in LO2, which is quite linked with the LO1 as well. So you can scale rate yourself, count your knowledge about contribution and strategies 1 to 10. What do you know about pricing strategy? Why? Why price? So price is one of the crucial things. Price represents the power of product. Price helps to satisfy the customer. Yes, so we need to be, pricing is one of the crucial decision in a product. So that's what is we need to make sure. So today lesson inductive contents is complete the calculation with cost per unit under the different methods which we'll go through. We discuss in lesson one as well. We can, and we'll go through the pricing strategies such as the marginal pricing, cost plus pricing, customer price pricing, markup and margin. That's all key will be focused today lessons as well. So we'll go back to here in, and you will see there costing approaches we can, indexation, that's the key element, and the market based pricing, that will also be focused today lesson. So let's please now we'll move back to our lesson slides which we'll go through. Okay, apply different costing methods. So we can use different costing methods. So first is marginal costing. Marginal costing is the cost of one unit of the product or services which would be avoided if the unit were not produced. If we don't produce it, won't be any incurred cost, and the marginal cost mean all the variable costs. Only variable cost charged to the cost of sales. Closing inventory is valued at the marginal production cost, and the fixed costs or the overhead costs are treated as a period cost. So period costs are the charge in the full into the statement of profit and loss, and if the sales increase one item, the profit will also increase by the contribution of one. And last lesson I also mentioned about little bit about contribution, and we discussed some formulas as well. So contribution is mean the sale revenue less variable cost. So what is the formula of contribution? Contribution, you can say other way, is a gross profit. So contribution is equal to selling price, or we call sale price, minus variable cost. What is meant by variable? The cost which change with the level of output, that's called variable cost. So always remember, the cost which change with the level of output is called variable cost, such as. Then we have other method is called absorption costing. Absorption costing, also known as a full cost, where the fixed and variable cost both we absorb into the product. So absorption costing, sales, opening inventory, full cost of one unit produced, and less closing inventory, full cost of the sales of, so that's we can find. And gross profit, normally in under the absorption costing, the closing inventory value will be higher than the marginal costing, because the inventory will be valued based on fixed and variable cost together. Under the marginal cost is opening inventory, variable cost of it's only based on the variable cost, closing inventory. Then you will minus sales, minus all the variable costs, you will get contribution, and then you will get, but in the absorption costing you will get gross profit, then you minus all other costs, will get the profit. So then the contribution, then you have a fixed cost, which in other, here we absorb, here we not absorbing, will minus as the product cost or the production cost, all so that's will get the profit. So inventory is valued variable cost, and inventory is valued at the full cost. Okay. Next we'll look the marginal cost is the closing inventory value on the marginal production cost, and absorption cost is closing inventory is valued at the full cost, where both fixed and variable costs will include. So increase in the period, absorption costing report higher profit, more fixed overhead included in the closing inventory then. So that can be in the, if you use the absorption costing method, your profit can be higher with the closing inventory, absorb both fixed and variable cost, and the closing inventory value will be higher. So it means your profit can be more. Decrease in the period, absorption costing report lower profit, lower fixed cost, overhead included in the closing inventory, then opening inventory. So the cost of the period increase, hence the profit is the lower. So we can look around in these, we can go through some numericals later on and in other units as well, and we'll go through in the next lesson as well. Okay, so unit cost card, how cost of the unit of the product we calculate. So direct material, how much material we have used, how much labor we used, any other direct expense. If you add them all, we call prime cost, also known as a direct cost. So then we have a production overhead. Overhead, like, it can be anything which we can't trace within a product, but still is a cost. That's called overhead product, like a packaging material or various other costs, indirect expense. Overhead is not involved in the production, but still is a part of it. So like, the maintenance department, so their overhead we supposed to be absorbed into, so we can say how much is cost. So non-production overhead, like selling, distribution, admin, these are the known, which we also keep in mind because we want to make sure the price will charge cover us and we earn sufficient profit out of the business. Because if we don't earn the profit, we can't sustain in a business. And a business is all about the profit. Yes, always we need to be, of course, we need to satisfy the customer. We need to be make sure. So unit cost card is as no next different method of costing we can use to decide, the batch costing, you're making goods into batches and that you can produce. Absorption costing, full cost, job costing, such as the construction or the builder, they have a different job. Like, people want to extend the house, they have a different, the costing, a different cost. They say to you want to extend 1 bedroom, 2 bedroom. So you have, that's the job, that's the job costing. Each job will be different costing, different profit. So marginal cost is mean the variable cost. The process costing, different process involved in the costing, that we can use it. Okay, this is activity-based costing, one other costing method. Activity-based, like you see ABC costing activity. Like say if you have more activity, more deliveries you do, it means you have more. So every time, single item you're going and deliver in the customer house, you don't plan the routes, properly, then of course your delivery cost will be higher. So what do you do if your activity reduce, if your delivery is reduced, your cost will be reduced automatically. Let's look at example, the cost of inward department, we have a 10,000. The cost of driving goods inward activity, number of deliveries, how many deliveries is 1,000 delivery and 10,000 cost. So 10,000 divided by 1,000 will get £10 is each delivery cost. So if the product X has 200 of these deliveries related to the product, what X product will be charged at the B as a cost. So we need to be look around the 10,000 divided by 1,000, £10 is per delivery, 10 times 200. So 2,000 cost should be goes toward the X product. So cost of activity per unit in X, because X produce sell 2,000 units, 2,000 unit divided by 2,000. So it's £1 per unit per delivery cost we need to be absorbed into the product if we're not charging the separately from the client. Yes, so that's we need to be look around. The job costing is the costing consists of single order of the contract. Feature of the job costing of every method have advantage, disadvantage. Work is undertaking customer specific requirement. Each cost is short duration. Jobs are through the process and the operations, and job costing is a question maybe ask you to determine the job price and add the certain profit, which we can, and that's good to be look around. Batch costing is total batch cost divided by the number of units we produce in a batch. So that's also help to decide the price, what price is per unit will be cost as a batch. Service costing normally is used by the service industry such as NHS, like hospitality, hotels, and the waiter cost, and various other people, because this is a people oriented where they lot of costs, human interaction, so a lot of labor costs are the service delivery costs. Service provided by the company opening in the service industry, service provided by the company in the service department, characteristic. Service can't be intangible. We can't see it really, we can't touch it. Is a service simultaneously is because the service is can't be, we can't store it. Perishable service is instant. Yes, it can't be stored. Heterogeneous service can't be standardized. It's a varies because it's a human nature. Sometimes you're happy from home and you provide a good service to clients. So we need to be make sure. And if you're angry with your someone's, yes, then of course the service will be drop as well. And we need to be well aware of. Huh? Anybody any question? Okay. Next, no standard cost. Standard cost is mean what is 1 unit standard cost. Always standard costing help to make the budget and decide the price. So think about the material A and B we have used, and that's the kg, and that's cost us in term of. So 18 pound worth of the material we use. The labor we use two types of labor, grade 1, grade 2 workers work on it, and that cost us 58 pound worth of the labor we use, 18 pound worth of the material we use. Total prime cost is direct cost is 76. So variable cost production one per hour, 8 hours is required, so 8 pound, and the fixed cost element is 24 pounds. So total standard cost of production is 108. It can be 1 unit, you can say one batch, whatever. That's our standard cost. So monetary rate, element, time by the resources. So always good to be see what is a standard. So if standard need is the realistic, is achievable, ideal standard, and it's that's match. So in the ideal situation, are the your standard need to be current standard based on the current environment, current the wastage should be kept in mind as well. Then next we have a target costing. Target costing is very popular to decide the price. So the traditional approach of the product costing, develop a product, determine expected standard cost of the product, and costs are controlled through the variance on the monthly interval. The target costing is mean you decide, you can add the margin and mark up there. Margin. What is the margin? Margin is based on sale price. Whatever sale price you will decide, you keep the margin. We want 25% margin on it. So if your sale price is 100, so your gross profit will be 25. Yes, because if you take 25 of 100, 25% of 100, that will be 25 pounds. So that's the way we can calculate, and what will the cost? Cost will be 75. So if you can reduce the cost from 70 pi, this margin can be go up to 30. Yes. So always we need to be decide. The target costing is good. You can make the target, and that's you can look around the price as well. That also is a good method to calculate the cost. Okay, think about here the price, market price of the product is we have a 500, desired margin we want 15%. So what do you do? 500 minus 75, so target cost will be 425. So that's the way we can calculate what is my target cost, what is my target profit I want to be, and that's we need to be achieved. So if you stay within target profit, of course you can increase or decrease, because always manager's job to reduce the cost and maximize the profit, and the profit is one of the sustainability in the business is a crucial. If you don't earn the profit, can you sustain? Think about it during COVID-19, how many companies is being closed. So when the lot of companies being closed due to this, so we need to be make sure we'll carry on earning the profit and sustain in a business. Guys, make sure you read all the slides and go through some activities which I'll go through. So target costing, value analysis involve assessing the value of every aspect of the product, and in order to devise ways to achieve it is the purpose of economically as possible maintain and they require the standard quality. So when you do, please just not the price. Yes, because people not just look the price, people want the quality. You may be heard of do value added product. Yes, we need to be make sure we'll do. So conventional cost reduction technique try to be achieved lowest production cost for the specific product design. Value analysis try to be find the least cost method to making the product that's achieve the desired function. Types of the consideration: can cheaper but good and the better substitute of the material be found? Can be unnecessary weight or the embellishment, I mean the waste of remove without reducing the product attractiveness of the desirability, or is it possible to use the standardize the fewer component. So value added activity cannot be eliminated without the customer perceiving deterioration or as a loss in the performance and the function and the quality. We need to be focused when we decide the price. So that's what we need to be looking at. Okay, another thing, when you do the costing, always we need to keep in mind the product life cycle, because the product at the introductory stage, develop stage, and decline stage. Think about new iPhone when launch is a high price. When it goes and the growth and then decline, then we can. So that's why we can wait, if we want to. But some people wish to be buy the new mobiles at the time when it's launch. Of course, they want to be first. They want to show the friends, the new mobile soon. So of course, we in the life cycle costing is the important concept. We can look around the throughout the product life cycle. What will be cost? The cost is one of the crucial element to decide. And this affect the profit and is crucial for the sustainability of the organizations. Okay, life cycle costing is a different cost. Is a pre-production cost. You will see there, production cost is higher than marketing and the services is cost there as well. And we can look around traditional costing, reduce the costing when the production has begun based on the series of 12 months accounting period. Life cycle costing is accumulate all the cost over the whole cycle to ensure the cover the revenue from the product and make use of discounted cash flow, the time value of money, because the pound, let's say, think about time value of money. The pound, 10 pound you have today and the 10 pound you will get in future have today. 10 pound is a more worth it, the pound 10 pound you will get in future. So we need to be always look around. If you're giving somebody 10 pound, that can be huge, because we need to think about how we invest in the real business and how we can maximize return. Okay, guys. Next, now we're looking now indexation. So 2.1 use index, price index. You maybe heard about the consumer index, retail price index, which measure the changes in the item of the expenditures is the average household retail price index. In the UK, we have a ONS, is called Office of National Statistics.gov.uk, where you can find these, the trend, the price changes, and the inflation. Index point, we can look around. So how many points increase, and so there's a formula is we can use it. The value, current value in the sales in year Y and actual sales in the year Y times by, we can look around the current retail price index divided by the retail price index Y year Y. Yes, Y the previous year and the current year. We can compare 2 years, base year or base period. So index also be measure the difference in the index value in the 1 year with the value and on the other year. So retail price rose 34 point between 2000 to 2003. So 100 to 134. So that's that went up. So base period is known as the base year and which we calculate. So what we do, the base period index is 100 and should be representative time period. So current period figure is and the base period. Current figure is at the moment and the base is the base year when we start and times by 100. So we can calculate these, the index numbers. So forecasting. Linear regression is forecasting sales. Apply the linear regression y equal to a plus bx. Couple of you this learn maybe in maths and statistics as well. It's quite crucial concept to look around. So y is represent, y is the trend equal to a we can say is the fixed cost, b is the variable, x is the number of units. So variable by number from 1 to upward. So which we can look around the regressions like here y equal to a is a 400,000, B is 3x, so we are producing 9 quarters. So we 300 per quarter suppose, so 300 times 9, so that's 2700 and 40,000. So if the seasonal variation in the quarter 9 forecast the sales, so we can look around the sales, the forecast as well, which we can do by carry on adding into quarters. Forecasting the value of X can be substituted into the equation of Y total to activity level, so which we can carry on chaining. So you will see there, if the fixed cost is 17,000 and variable cost per 3600, Y equal to, if the activity level X is 13,000 units, yes, so 17 plus 3.6 times 13, so 63. And of course, how many units we are producing, we can decide as well, so we can calculate the cost. That's way. Anybody any question? If you have, you can drop me email please, and I'll further explain you as well. Total production cost, we have been given this period for 1000 units and 2000 units. So A is A plus BX, so 1000 unit A into 1000 is 59,000 is Y, and then of course A we need to find, and the 1000 is a B. So what you do, 25,000 is, yes, so we can look around 25,000 for 2000 units. So you take the difference, 15 and 25, there is a difference is a 10. If you take the difference here, there is a difference of 1000. So B equal to 10,000 divided by 1000 is 10 pounds. Substitute this equation, 15,000 A plus 1000 times 10. So A is equal to 15,000. So total production cost are 1400 units. So 1400 unit times 10. So that will come 19,000. So we can find different by using high and low method, where we can look around the high unit and low unit cost difference and the unit difference, and we can find the variable cost, and we can decide it per unit cost. CVP is called cost volume profit analysis, is the decision making, and the short term fixed cost is don't change, but the variable cost is carry on changing. The contribution per unit is the selling price minus variable cost profit, sale volume time by the contribution per unit minus fixed cost, so you can find how much profit we have in certain period. These are the formulas we can use if we want to be use the break even. Total fixed cost divided by total contribution per unit. So required contribution is we can find by using the PV is ratio, or we call cost to sales ratios. So which we'll go through in the next slide, and that's these, the fixed cost divided by contribution, so we can find break even. And so we'll go through here few questions. So selling price is a 15, variable cost is 12. So 15 minus 12 is 3. So 3 is a contribution per unit. Fixed cost is 5400. Then sale per annum is a 3000 units we estimate. So what we do now, so first we are using the break even in units. So fixed cost divided by contribution. Fixed cost is 5400, contribution is a 3. So 54 divided by 3. So if you produce and sell 1800 units, we will be at break even. So our budgeted sale is a 3000, so we are selling more than the break even. So what is the contribution? What is the contribution ratio? So 3 is the contribution, 15 was the selling price time 100. So there is a 20% contribution to sales ratio. Yes. So break even 5400 divided by 0.2. So if we sell the sales of 27,000, yes, worth of, that will be, or the break even in unit times by the selling price, you can find what will be the revenue when the sale value where the will be break even. Margin of safety is your budgeted sale, which is 3000, we estimate. Break even sale is 1800 divided by the budgeted sale, so we can find what is the margin of safety, because you're selling 1200 units more than the break even, so 40% we are save as a margin. So sale volume to achieve the profit is also known as a target profit. So fixed cost plus target profit divided by contribution. If we sell 2900 units, we can make the profit of 3300. The sale volume to achieve the target profit, fixed cost plus target profit divided by contribution. So we can find our contribution to sale ratio. We can find the revenue. Okay, that's the way we can calculate limiting factor. Always we have a limiting factor. Limiting factor is a crucial, because it's called constraint and we have in a business constraint. So limiting factor, like it can be labor hours, it can be machine hours, and we need to be make sure we produce the unit. Those will give a high contribution. Huh? Okay, next 2.3 apply the range of market-based pricing strategies. Strategy is very important because we can earn more profit and we can look around how we can maximize the profit. Huh? So look here, the unit we sold is given and the selling price we given, the price we charge, variable cost, contribution per unit. You will see there is a contribution different. So number of units sold, and on the 12 we can sell more unit and the contribution is this, and less the fixed cost if we do, and we can maximize profit at this point. So it's better to be we can sell at that price so we can maximize our profit, maximize our sale, and the contribution will be high. So we need to be looking on the quantity, price, revenue, and the marginal revenue is always marginal revenue mean the revenue is of every successive unit. That's we call. So is the price skimming mean is a high price. So like think about Prime Marks and Marks and Spencer. Marks and Spencer always charge the high price, but is a high quality, and some people like high quality. But the Marks pay, mm, Primark is charged the low price because of course low price is mean low quality. But ultimately, you need to think about the volume as well. When we'll sell in more, we can maximize the profit as well. So pricing strategies can be penetration. Penetration means the low price, the price which we charge for the time being lower, such as the Primark. So then product line price, different product which are different price as a volume discount. If you buy one, if you like, you buy one Lucozade, you buy four Lucozade drink, energy drink, a lot of people like it. So we need to be think about different price. We can get £1 one and four we can get, the 50p each, in £2 four. So that's, we need to be decide the price, cost based pricing. Yes, cost and what is called, you can add it the margin and the markup, on it. So that's we can look around. Always look around the opportunity cost, because if you're attending the lesson or you're doing one thing, you're missing other thing, that's called opportunity cost. And opportunity cost is very crucial. Giving time to somebody is maybe you're missing the opportunity, and opportunity cost, you need to look around the cost and benefit analysis. We always have to do which one is a better for you, which one is best for your family and kids. Okay, market-based pricing, always we need to be look around market-based approach, which is always you decide the price, what the competitor will do and what the competitor will charge. So then the practical method of transfer pricing, different pricing in different location, we can change. This is one of the case. You guys make sure you read and try to be look around, discuss the transfer pricing, and that's always good to be transfer pricing different location and different we can transfer. So this example is that further help you to clear your concept. Okay, so this is all about which we discuss, and please the pricing decision. I copied the link for you to do the quiz. You can watch the video, which that will help you to understand the concept. If anybody any question, please, if you have. So today lesson we discuss about different costing methods. We discuss about index. We discuss about how we can decide the price, is the skimming, penetration, or the customer base, or the competitor base, or the market pricing, and I discussed with you how we can calculate, the break even, margin of safety, and all these formulas as well. Thanks for listening and attending. If you have any question, you can drop me emails on these emails, and I'll try my best to get back to you, and hope so I'll speak to you during our next lesson. Thank you. Bye-bye.